Welcome back to another Rockstar retention video with MonitorBase. Thanks for joining us. I'm Lily Staniforth.
William LeBaron.
I'm Louis Zitting.
Today we want to highlight a strategy to help you save money on credit reports.
Louis and I were talking to one of our clients last week, and one of the things they shared is they were spending about $600 on credit reports per loan that they funded, which is comparable to how much they spend on appraisals, which to me was, absolutely crazy because when I was originating, a credit report cost $26 and that was it. And today you're talking about, to close and fund a loan, people are spending $600 on credit reports. And this wasn't a small lender with really bad credit report costs. This was a top 20 lender doing high volume. And so it was pretty mind boggling. And it led to some conversations within our team about how our systems can actually be very useful in cutting back on the number of credit reports that you're pulling while still setting loan officers up to succeed, still giving them the information and the access that they need to get their job done, but not having to rely on a $100 per credit report pool for a bunch of stuff that doesn't close.
Yeah, I mean, one of the struggles for an LO, and I was an LO too, and remember this, that when you talk to somebody that was interested maybe in a refinance or a purchase, it was really hard to get to the next part of the conversation without getting to the credit report conversation, right? Because you need to know what's their score. Can they even, is it even time for them to start doing this? Or do they need some work on their credit? Or if it's a refinance, what's their mortgage balance? What's their revolving debt balance? What's their DTI look like? And so I think that, that still drives originators to want to pull a credit report, because then you're asking one thing rather than these 10 different things. And it's not easy to just say, hey, we need to not pull so many credit reports, because we need to give the LOs tools of what to do in place of that thing that they've done forever that kind of progresses the deal.
Well, and there was a transition last year, about 14 months ago, we industry-wide saw a really, really substantial increase in hard credit report costs. Many people were paying double or triple what they were previously paying. It was a really big jump. And so you had a large migration of people moving over to and utilizing soft pull instead. And that solved a bunch of problems and it was helpful. But ultimately what happened was soft pull costs 2 months ago went up. And now soft pulls cost oftentimes just as much as or close to as much as a full credit report. And the soft pull has some inherent disadvantages. It has some advantages, but it's a balancing act. But as soon as it's that costly, loan officers are back into a realm of, if they're going to answer the simple question of what is your rate today, we've all seen a rate sheet and borrowers never really understand it. They think there's a rate that's printed on the sign in the back and you're just somehow hiding it from them. But it's like, no, it's a rate sheet. It's a metric. It's a matrix, and it's dependent on so many different loan level pricing adjustments that in order to answer the question of what's my rate going to be, what's my payment going to be, which is what the borrower cares about, the loan officer has to gather, like Louis is saying, mountains of information. And the easiest way to gather that is to pull a credit report. So, we were driven towards soft pull, and that's now not financially viable in a lot of circumstances. And loan officers are back into the space of pulling full credit reports. And, it's just exorbitantly expensive. So I think it's a situation where the industry as a whole has to figure out a way to adapt. Otherwise, this is just passing. It's either going to, or it already is passing the cost directly down to the consumer. And it's not in their best interest that this is occurring. That's a very expensive bill for the mortgage company to pay, for the branch to pay. And ultimately, that's going to be paid by the people buying the home. It's going to increase the cost of doing a transaction for those borrowers.
Not to mention that it's a really big pain for the borrower to go through that whole process, not only as far as giving sensitive information to the loan officer, but also the experience that they might receive after having their credit pulled, where they're getting bombarded with offers and phone calls and what have you. It's a whole ordeal for the borrower.
And that's totally true, Lily. So the strategy that we are going to talk about here is how you can use the credit report that you get with each of your MonitorBase alerts, but particularly the predictive alert, to avoid pulling a credit report early in the loan process. And just a teaser here, we have a product that'll be out here soon, and it's going to give you access to this kind of data on anyone in your database, not just those predictive alerts. But I want to walk you guys through how using a predictive alert gives you all the credit information you need to answer the question of what is my rate going to be? What's my payment going to be? And enables a loan officer to continue a loan conversation, take them through the process without that full credit report. Because, well, here's the math. Industry-wide, there's about a 53% pull-through rate, meaning you're going to take application after application after application, and only 1 in 2, 53%, are going to close and fund. 47%, that application is going to be dead. Nothing's going to occur from it. It's a notice of withdrawal, cancellation, incomplete application. And what that means is these loan officers are taking an application and pulling credit, and half the time that goes nowhere. But worse than that, surprisingly, is the average loan to close a loan on average takes about 2 to 3 credit reports. Oftentimes that's because the application, the closing process takes so long. Borrower, co-borrower, and then every so often you have to do an update on the credit. You're talking about situations where you're pulling 6 credit reports per funded loan. And so that's where you have lenders spend that $600. So our goal is to help you eliminate having to pull the credit report on those pre-quals that never make it in underwriting, never go anywhere. And that's going to save you a bunch of cost and effort and give you the information right up front. But on top of that, if you can actually engage with people and get the answers you need from a score perspective, debt perspective, out of the predictive alert, work them through, answer their questions, give them loan comparisons, give them the information they need so that they're satisfied, you can eliminate 1 credit report from your 2 to 3 that you're doing per funded loan. It's not going to get rid of all of them, but it can oftentimes help you get further into the loan process before you pull that full credit report, which reduces the likelihood of having to do an update, having to pull a second report when that one expires. And so the strategy, guys, is look at the credit profiles that you get with the predictive alerts. You've got scores, you've got debts, installment, revolving, balances on mortgages, it's and payments. It's all of that information that you need to do something like a loan comparison. So if someone's talking to you about a debt consolidation refinance, take that information, go and put that into your, MBS Highway tool or whatever loan comparison software you're using. Populate those fields, give them the loan comparison, help them answer the question of what their rate is going to be and what their payment is going to be, and choose a loan program. And you don't have to pull a credit report to get all that information you need. And you don't have to sit here and ask the person 100 or 1,000 questions, as the case may be. So really, guys, it's an underutilized aspect of our system. We're giving you a credit report with every single one of these alerts that you get. And it's a lot of information. It's way more than most people realize.
Yeah, and this is, it's also a soft pull. So, you can't make a lending decision on a soft credit pull, right? That's why there's still the need for the real credit report and underwriting in order to make a credit decision. But this is in order to offer the consumer the product that they want, right? So if you have that information ahead of time, then you don't have to go through all of that, back and forth before you get the consumer an answer, right? So it's as good for you as them. You can go to them equipped with knowing everything you need to know, and being prepared to where you don't have to take a bunch of their time. You could say, hey, yeah, you definitely are going to be able to save some money if we pay off that debt and that debt. Even with your current interest rate, blah, 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 you're going to save $500 a month, right? Or a first-time buyer just, knowing that they're credit pre-qualified before you call and reach back out. Because I'm sure we all call and reach out multiple times from alerts in our CRM of somebody that wanted to buy a home 18 months ago. And how many of those credit reports do you pull before you find out that they're actually in the market and they've improved their credit? Um, so it's the credit report is like a wonderful little cost savings side benefit, but the time savings for you as an LO and the consumer, it's like you can just get right into the conversation.
I love what this does for the consumer experience because that's exactly, and we highlighted this before. That's what the consumer is looking for is answers, clarity. They want someone, a professional to talk through their experience with because this is their life, their financial situation that they're looking to make a decision for. And if they can talk to you and have this conversation where you're really detailing the numbers that apply to them and their circumstance without either pulling their credit, which again is a huge commitment, or just having to have a very vague hypothetical conversation, that makes a really big difference to them. And also, as a side benefit to you, that differentiates you from other lenders where you're able to have that conversation in depth without that barrier to entry of having to pull their credit.
Well, and it's not a good borrower experience to get on and be pushed into a loan application, which you're going to either close or deny them for. Because, like, I don't know if we think about it enough in the industry. If I'm denied for a mortgage, that's a negative experience, right? It's a lot of paperwork.
You're not going back. You're not going back to that LO probably.
Right. And so when you're calling and you're looking for opportunity, cash out or home buyer, and it's like, hey, before I can tell you whether this is a good idea for you or not, or tell you what your new payment's going to be, or help you decide if you should be thinking about a move at this time, I need you to apply for a loan with me. That application is an emotional barrier. And so being able to have all the information you need to answer that person's questions and let them get further into the process of making that buying decision first is really important. And that's why we've always felt like those total cost analysis, those loan scenario tools are a really valuable tool set. It's helping the borrower check the boxes of, do I qualify? What is it going to look like? What's the right decision? And we're here giving you the data you need to accomplish that over and over every single day. I mean, these loan officers get one of these a day oftentimes. And it's enough to have a really productive conversation all up front without having to ask anything or get any kind of commitment from Louis. And then I'm leading with value and leading with what they want, which is huge. And I think those are underutilized strategies in what's available to our users and, just the reality of what action they're taking. Because the person we were talking to last week, that loan officer has access to our system. And I would bet you they were pulling credit reports on people that they could have gotten that information they needed out of MonitorBase.
We know from just the analytics from our system, first-time home buyers usually have 2 or 3 credit reports before they actually move forward. And in today's market, it's a similar thing for sellers or refinance. It used to be quick and short, pull credit and move forward. Now it's like 2 or 3 credit reports and an extra month or two before that, transaction really happens.
Well, especially moving into spring season where inventory is going to shrink back down. People are going to be in extended fights to get a property under contract. Those are the scenarios where you're pulling another credit report. It's like, I don't care if it costs another $200. This borrower has put in 5 different offers and hasn't won anything yet, and they're still in the market. And so you just have to keep riding that train, and it's quite costly.
We mentioned looking into this data that exists on all of our credit related alerts in MonitorBase, specifically the predictive alerts that you're receiving. But we did mention this tool that we're coming out with in the near future that's really an on demand. Somebody who may have not triggered an alert, you can pull this data on. I'd love to touch a little bit more on that tool.
I mean, we can't go into too much detail, but what we're doing is we are actually, as your data partner, we have access to all of the credit data all the time for the people in our database. And we just get to see what's happening there. We use that to help predict. We use that for our credit improvement alerts. We use that for our real-time in the market inquiry alerts. So the way it works is we already have access to your data set. That's how we do all of our monitoring, predictive inquiry, credit migration. We're already looking at that credit profile. So on demand, you're going to be able to go in there and select who you would like to get that kind of credit profile information on. And that's, rather than us saying, hey, this is the person that's likely in the market, it's this on-demand experience where you are selecting and identifying who you'd like the information on.
Yeah. So, we're telling you the top 5% or so of the people in your database, those are the predictive ones, plus the ones that are applying with a competitor, right? That's a very small amount of your database. Those are just the most predictive at the moment. But you may have a product change, or, rates come down a half when the Fed finally decides that things are slowing down. And then you may want to talk to 10 to 20% of your database right away. So so that's kind of the idea. We'll get you much more information on that, but that's I think that's going to be really helpful, and you're still going to get a credit profile on all those consumers that you gave the offer to, so that you can reach out and follow up with valuable information, comparisons, relevant information, rather than just, hey, I'd love to ask you a bunch of questions.
Well, that's the age-old struggle, I think. The loan officer says, I need to reach out and I need information from you before I can tell you if I can help you. And we want to flip that on its head. We want to give you the list of people that you can help. And then when you follow up, you're doing so with confidence that you can help them. And, that's why when rates drop, loan officers actually take action, and they do call and they follow up and they nurture that list because they have confidence.
You got value to talk about.
Exactly. But when they don't know what value they have to talk about, they don't want to call and shoot the breeze, take a loan application before they can find out if they can help the person. And so it's really leading with the concept of these are the people you can help, and helping the loan officer do that in a way that's effective from a sales perspective and cost effective from a business perspective. And we really think we've got that system balanced here. So we're excited for that new feature. You'll learn more, but guys, there's no reason to wait. You already have access to this strategy using the predictive alerts, using the inquiry alerts, using the credit profile data that you're getting with every single one of your alerts. So that's what we're recommending today. That's kind of our retention rockstar trick, tip, whatever we want to call it today. So if you want to cut those costs, that's the strategy. Send this video to your loan officers, explain what they're able to do there. Because I think a lot of people just aren't familiar with the data that's accessible to them.
Thanks for joining us today. As William said, share this video with anyone you think would be interested in hearing this message. Feel free to comment or reach out to us with any questions, or if you want to get on that early access list, let us know. And thanks for watching. Have a wonderful rest of your day.